This week's trades, market movers, and technical levels that count, wrapped up with clarity and precision. This is Weekly Wrap Up with Verified Investing.
Hey everybody, welcome to the Weekly Wrap Up. My name is Gareth Soloway, Chief Market Strategist here at VerifiedInvesting.com. What a day and what a week on Wall Street. Today was unique because we got hot inflation data via the PCE. We got weak economic data via GDP, right? In fact, let's take a look at those right now. Notice in the red box, that's GDP 1.4% versus the forecast of 2.8%. So much weaker economic growth. What surprised me here was with all the CapEx spending from these AI companies, the GDP was still only 1.4%. What that tells me is that if you take out that spending from these AI companies, the US economy would be in recession. Then go to the bottom two orange boxes. Month over month, 0.4% inflation versus 0.3% and 2.9% year over year inflation versus 2.8. What's so shocking about this is literally a week ago or so, we got the CPI data and it showed a dropping inflation number. Now, I cautioned against this last week when we got this data. I said, guys, don't trust this data. It's not complete data. It's been essentially massaged a little bit and there's parts missing. And ultimately, the PCE is the more accurate number. First of all, remember, CPI data, 30% of that data. So CPI 30%, again, is housing, rent, etc. So if rent just falls, it basically skews the whole number, even though when you and I go to a store, we're like, wow, those prices went up. Wow, that price went up. Oh, look, oil's going up. Right? And we talked about this. We said in January, oil was up 15%. But in the CPI data, because rent is such a big percentage and there were some missing components, it did not reflect it. Well, today we saw it, folks, and it was not pretty. Now you have those two factors, which are both negatives, and the market was a little shaky pre-market. Okay. And then the markets opened. And by the way, the shakiness here is weaker economy, hotter inflation is what's called stagflation. It's the boogeyman of all scenarios for the economy, but it was saved. And don't think for 1 second that this wasn't planned. An hour after that data came out, all of a sudden the Supreme Court ruled that Trump's tariffs were illegal. And all of a sudden the market said, wow, now prices can fall because the tariffs aren't adding a tax to it that everyone's paying. And that therefore negates the hot inflation data. And the markets breathed a sigh of relief. All of a sudden, these tariffs may be going away. Now, listen, it's very possible the Trump administration will figure out other ways to put this on. But right now, the market said, you know what? This now negates the negativity. This might even be stimulative to GDP. So all that negative economic data, done. It's out the window. Market said, forget about it. This cancels it out. Markets rallied higher. And like I said, don't think it was a random occurrence that this number came out or this decision from the Supreme Court 1 hour after hot inflation data. Amazing, folks. Absolutely amazing. Let's go into the charts here. Here's your daily candle on the S&P 500. Big move to the upside. Well, not big, but about 0.7%. You can see we opened lower. We were even lower pre-market because of that data. But by the time we opened, we were down. And then once that news hit, the market spiked up. But even with that, look at where we are. Is the market up significantly? No. Look at this. We're basically at the level we were at on Wednesday. Wednesday's high, that's where we close today. Now, does this change anything? That's the big question that we should all be asking. Does this decision by the Supreme Court all of a sudden flip this into a bull market again versus a market that's literally going over a cliff or on the edge of a cliff? And the answer is, on a technical, purely probability basis, it changes absolutely nothing. Why? Let's look at this. Okay, so number one, we still have a head and shoulders pattern formation here, right? So head and shoulders, bearish head and shoulders. Now it hasn't triggered, so we have to be cognizant of that, but you have a very clear shoulder, head, and shoulder. Now for it to trigger, you need to break the neckline right here. It has not broken yet. You can see it pierced it intraday a couple times. It never broke it. Okay, so that's number one. But number two, which is even more important, is that we are still within this bigger parallel. Now, the parallel doesn't really say, okay, the market's going to collapse today or next week or next month. What it tells us is it limits the upside. It limits the upside ability for the market. It essentially is as if someone told you to, hey, run this marathon, but 100 feet in front of you, I'm going to put this massive brick wall, and you're just expected to go right through it. And you're going to be like, okay, well, if I run at this full speed, I'm going to slam into it and I'm not going through it. That's what this is to the market. It's literally a brick wall. Okay, so we have a brick wall right up here, and you can even see right here it hit it, and that's the last time it touched it was right there. Okay, all right. Then we also have this trend line. This trend line is a beauty because look at this. I'm going to get rid of this here. It basically marks your low from liberation to tariff sell-off in April of 2025. Low pivot, low pivot, low pivot, breaks down, retraces, rejected, and then we've still been chopping sideways. And so essentially the reason why this doesn't change anything technically is we're still stuck below two brick walls now. Not just one, but two brick walls. We have the white line and the yellow line. And until the market can clear that hurdle, then the path of least resistance remains to the downside with massive overhead resistance that has proven itself, especially that big parallel going back to 2020, that it has marked the top and the bottom on every market. What do I mean by the bottoms? Well, again, just go back to this. Let's get rid of that line. I mean, literally this parallel, the COVID low, bear market low, and then the liberation sell-off low. And here's your high. And so again, that is your brick wall. And until that gets taken out, there's no change here in the overall guidance of what the technicals are telling us. Now, listen, it's not 100%. It's not foolproof. It's not like, you see something on the charts and you're like, oh, there's a 100% chance that this is, no, there's no such thing as 100%. But it's probability. It's the idea of you being the casino, not the gambler. Who has the odds in their favor? When you follow the charts, you get the odds in your favor. Okay, not perfect, but at least in your favor. And that's, again, what most hedge funds strive to do. The best ones do it very well. The other ones don't do it so well. But the point is, that's what hedge funds do. They're analyzing. A lot of them are analyzing what I'm giving you in these videos. And that's essentially why I love being able to kind of guide you guys in this way, learning the charts and getting into it. All right. Let's go to the NASDAQ real quick, check in on the NASDAQ composite today. And the NASDAQ composite, you can see again, we have our support line here. We got a nice little bounce point, 9% on the close. So not even 1% up. But again, it keeps us above key support here. If this breaks, by the way, your next target on the NASDAQ is basically 20,000. So this needs to hold, guys. This is a huge area around 22,000 to 22,300. If this breaks, huge downside. Now, in terms of upside, sure, we could technically trade back up here. But again, that's limiting your upside. So what's our upside reward? Remember, as a trader or investor, you're always analyzing risk versus reward. What's my risk? What's my reward? So if I go long here, what's my reward? Well, let's find out. Let's do a measurement. We're currently right here. We go up there, your upside 7.5%, which actually isn't horrible. I mean, that's a decent move. That would be your max upside potential. Your downside, if you crack this level here, and obviously, we're not there, but you'd have to break that. But if we did, what's your downside here to your first major support? About 12% from the close today. So again, in terms of where we are right now, it's slightly, the risk reward is favoring the downside. And also you have to respect how powerful this is up here. Now, the DJI, the Dow Jones Industrial Average, look at this, guys. This is a spooky chart. Why? Well, number one, we have this long-term trend line that acted like support over and over again, right? And then when it broke, it acted like resistance, 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 resistance. But what's more important here, and this is what I'm watching for next week, especially with NVIDIA earnings scheduled to come out next week, watch this trend line. Look at this. This has not broken yet, but it's getting squeezed between these two trend lines. My guess, based on the charts, based on the angle of this upward move, is we might get a little bit more upside, and then we're going to break, and then the floodgates open on the Dow. So watch the Dow very closely here next week, and then in the next couple weeks. But with NVIDIA earnings next week, this could be a big, big deal. Now, let's go to the 10-year yield. Now, the 10-year yield today did almost nothing. And this is kind of interesting, right? Because you say, well, inflation's higher, so the Fed is probably going to cut less, so shouldn't yields go up a lot? Well, yeah, but essentially think about it like this. Hotter inflation generally would make yields go up, but a weaker economy makes yields go down. And so GDP was weaker, inflation was hotter, they cancel each other out. And so yields actually did exactly what you would expect. They didn't do anything. They just paused here. Now, what's more important on this front is the fact that you have the beginnings of what could be a bear flag. And this tells me that if this pattern continues, eventually we do dump out, which one of two ways, right? It could tell us that maybe inflation isn't so bad because of the tariffs being negated. We'll see again how that all plays out with the administration, obviously. But it also could tell us that there's weak economic news on the horizon. And that would also be another catalyst towards lower yields. So right now, yields, it's very early on, but are making a potential bear flag. Now, we had today some other issues here. So take a look. Oracle, the software stocks, got it getting pounded again. And this is something really interesting because they've been crushed already, but the fear about AI killing off the financial software stocks, it hasn't abated, and it actually arguably increased today. You could see it here today. Now, granted, I actually still like Oracle down here. I actually think it's overdone. I'll show you why. So essentially, what are you doing here? Look at this. Off of this up move, little V bottom, cup and handle pattern. To me, that's a beautiful little bullish pattern. So I actually think Oracle will turn up. But look at CrowdStrike today. CrowdStrike down 8% on the day today. We also saw other stocks out there that are software related taking a little bit of a beating. On the other side of the coin, Google had a great move today, bouncing. Look at where Google went, guys. Right down here to this gap fill a few days ago, and then snapped right back up to the upside. So just interesting to see that as we go through. All right. So a couple little tidbits there. Microsoft, another one that has been plagued by the sell-off in software stocks. This was down again today, but it is still holding major technical support. Okay. All right. So we got that going on there as well. A couple other things to go over here. We got to look at silver and gold. We're going to look at those right now. Let's take a look at silver. Okay. Silver here on the charts. You can see big move up on silver, a total of about 7.5%. But on silver, look at this. It's still far away from major resistance. So it still's got a ways to go before it runs into a big resistance area. On the other hand, their downside support remains around $70 to $71. So right now, good move up on silver. But remember, I gave you guys this game plan. I said, guys, this is a down move, and this is just going to gyrate in here. And as long as it stays in here, who knows how long, but eventually it breaks to the downside. All right. And essentially what this does is it's digestion, right? Digestion of this big move, just like in the reverse. You have an up move, and then you get this digestion, which then yields to that next move to the upside. In fact, you can almost see that right here, right? You up, and then look at this, and then boom, it broke out. And you can see, so it's kind of the inverse of that pattern formation. One of the amazing things about patterns, they work regardless. Bullish pattern, bearish patterns, all the same. Now look at gold. Gold showing signs of life today, but it has not broken out. Watch this closely, guys. Again, you have this area we're now hitting the underbelly of resistance at 51.25 to 5100. If we can break through this, you actually have a shot to get back to 5400, but don't get too excited. And the reason why I say that is because we haven't broken through yet. Now, if it breaks through and closes above, okay, game on. But remember, respect your levels until proven otherwise. It means you got to respect, even if you're bullish, you still really technically should respect resistance, and bearish, you still got to respect support. Support is support until proven otherwise. All right, this is a mantra of good technical traders. Next up, let's take a look here at Bitcoin. Bitcoin, guys, I continue to be a bull near term on Bitcoin. Bitcoin, again, I honestly think stagflation is the best case scenario for Bitcoin. And again, we'll find out in the coming days, if in the coming weeks too, if we get a move here. The reason why is if you have a weakening economy, corporate profits go down, the stock market should fall. If you have high inflation, well, then guess what? That's where you hide in something like Bitcoin or gold. Now, right now, Bitcoin's been kind of left for dead, but I do think there's too much bearish sentiment. It opens the door for a breakout near term, not going back to all-time highs anytime soon, but a breakout above 70,000 that could yield 80 to 85,000. Interesting idea there, but I do think stagflation is a positive for Bitcoin overall. So just something to keep an eye on there. And then lastly, oil. Oil didn't do much today. Again, I unloaded my oil position yesterday for about a 17% gain from this breakout level here. So great move there, but it really didn't do much today. And then same thing for natural gas. Nat gas really just stayed on the sidelines and chopped around. A small gain today, up 2% on nat gas. So really at this point, neutral on both natural gas and oil. And really going into next week, we have to focus and continue to watch very closely the economic data. So what's the economy doing here? Is it getting weaker? Is inflation going to stay high? What are we going to see in that respect? But also the number one thing for next week that I am focusing in on is NVIDIA earnings. Because again, that could quell the fears in AI, or it could mount those fears to epic proportions. What will happen? I'll be here at Game Plan Monday through Friday, 9 a.m. Eastern Time live to guide you guys through whatever goes on next week, the levels, the trades, the probabilities, and the charts. No nonsense, no BS, just charts. You guys go have a great rest of your day. Have a great weekend. Thanks so much for supporting us here at Verified Investing. We'll talk to you soon. Take care.